Well, good afternoon, ladies and gentlemen. And I should say, of course, good afternoon for those of you who are joining me on the East Coast today. So I'd also say good morning to those of you who are joining us in the Central time zones, the Mountain time zones, or Pacific time zones. And of course, we also want to say good evening to those of you who may be joining us from across the pond and parts in UK or Europe. And good early morning for any of you who are joining us from parts of Asia or parts of Australia. Welcome to today's presentation for the radioactive trading techniques. As you read this morning in the promotional email, Kurt Frankenberg will not be with us this week. Kurt, of course, is the founder of Radioactive Trading and the author of the blueprint. So we're going to take some time today to review the 3 core principles of radioactive trading. We're going to go over the forcing an ideal size trade, what's called the fist, the ATM bell curve, and of course the red line. And then after that, and we take a look at the initial RPM setup and why we set it up that way is related to the 3 core principles, what we're going to jump into is a little bit of trade comparison. A lot of times new investors who look at the radioactive profit machine, the initial setup of that unique married put, will ask, well, can I substitute stock for a long call? Can I enter the position using a naked put? Can I just buy a call instead? And we're going to talk about that as well. So we've got a lot to cover today, so let's go ahead and jump right in. One last moment. We did get a question from WE that came in already. Can your process be used in the futures market? Well, the main concept that we'll discuss today about radioactive trading is forcing an ideal size trade, effectively and properly limiting your risk in any position. Of course, that can apply in any market. But as we go through the presentation, I think you'll be able to see for yourself, will this match what you want to do in the futures market, and can it be applied in the futures market for you? Now, that being said, I just want to remind everyone I do have points in this presentation where we're going to pause for questions, but I am flying solo today. I'll keep checking the questions occasionally, but I am flying a solo today, so I may miss a couple of your questions when you send them in, and then I'll go back to them later on. But please feel free to send in your questions as we go through the different points if you have a question regarding what we're reviewing at the time. All right, well, let's just briefly introduce radioactive trading. Many of you are probably familiar with radioactive trading. You've gone to the website, you've downloaded that free white paper, the sketch, you've seen a general introduction, or maybe you've joined us for a previous webinar. So you know a little bit about radioactive trading, but for those of you that are brand new, radioactive trading is a unique trading technique that was developed by Kurt Frankenberg. Around 2000, what he had done is spent a couple $1,000s to go to a weekend seminar to learn how to trade covered calls. And the first 2 months after he graduated from that 2-day weekend course, he started to do very well with his trades. And then his 3rd month, his guru told him, hey, you could do a lot better. You're doing so great now, you could do a lot better if you traded on margin. And there was never any discussion about the risks of covered calls themselves, and especially the risks of covered calls using margin. So Kurt essentially got stuck in a trap where the position he was in that 3rd month essentially wiped him out of everything he had set aside to trade covered calls. But he didn't give up. He kept looking at the various options strategies and decided to, hey, instead of focusing on getting premium up front, capping my gain on a stock that I think is bullish to begin with and leaving my downside open to risk, what if I reverse that concept? I focus on guaranteeing a limited risk first and leave the upside open. And that's the starting point for every radioactive profit machine. Now, after we open that position, which we're going to show in just a moment, the initial setup, we then can apply 10 different income methods to reduce that initial at risk and bulletproof the positions. And bulletproofing means when we've lowered our risk, so our cost basis in the total position is lower than our guaranteed exit, we now have a guaranteed profit on the downside and still have potentially an unlimited upside. This position, this technique forces us to trade in our portfolio the axiom of cut the losers short and let the winners run. We are forced into that position when we trade radioactively. Now, I'm Mike Chupka. I'll be your presenter for today's presentation. I'm the Director of Education here at PowerOptions. I've had the great pleasure of working with Ernie Zarenner, the founder of PowerOptions and the PowerOptions staff for the past 9 years. I started out the same as most of you. 9 years ago when I started trading and working with Ernie, when I applied to trade options, I was only allowed to trade covered calls. And I had the same mixed sentiments that many of you might have had with trading that in your portfolio, that eventually covered calls end up as a sorting machine. You know, you have some months where you're gaining your 2%, 2.5%, or 3% as you get assigned, and then you're taking that capital and moving to another position. But then in the 4th or 5th month, you might only have a 50-50 win-loss ratio, but you notice that the 4 or 5 positions you lost on you actually are down 15, 10, 12%, and that essentially wiped out the past 2 months of previous gains. So you only made 2 or 3% on the ones you won on, but the ones that are stuck in your portfolio now that you're keeping are down 12 and 15%, so you're right back where you started from. And I sampled other positions as well, moved into diagonal calendar spreads, and for a time period there, the diagonal calendar spreads were the most successful and profitable trading strategy I've ever invested in. And shortly after that, 4 months later, they were the strategy that offered me the biggest losses that I've ever experienced in my portfolio as well. Well, I came across Kurt Techniques 4 years ago. He was a member of PowerOptions, and he called up for a coaching session on using the historical tools. And when I first saw the initial setup and what he was looking for, I told him that I think it's great that you're limiting risk in this fashion, but I don't get it. You're putting so much money into this position that I don't see how you're going to make a dime unless the stock moves up 10, 12, or 15%. And he said, oh, really? Well, let me show you exactly how I do this, and I'll show you how I make money on these positions. And so I joined Kurt for one of his free presentations, just as you're doing now, and I was so impressed with the techniques 4 years ago. I invited Ernie to join me for the next few live presentations, and Ernie was so impressed with the techniques. We at PowerOptions decided to partner up with Kurt, enhance our tools on PowerOptions to work with the RadioActive Trading techniques and the married put strategy, as well as enhance the portfolio tools to work with the various income methods as well. And I've had more success with RadioActive Trading than I had with any other strategy I've traded in options over the last 9 years. That includes covered calls, naked put selling, standard collars, which I still trade today, straddles and strangles, diagonal calendar spreads, of course, and even iron condors and the vertical spreads. And the reason why, again, is because I'm forced into that position where I cut my losers short. So even if I'm wrong, I'm only risking a single percentage of my capital invested, but when I'm right, I can leave the upside open to have outsized gains, I should say, on the upside. So for the past 4 years, my portfolio has been mainly made up of, at any given time, 50 to 60% of my trading capital is in the married put techniques, the RPM positions, radioactive profit machines. About 20 to 30% of my invested capital is in standard collar positions, and I still keep about another 5 or 10% of my portfolio into credit spreads or iron condors on the broad-based ETFs and indexes. Well, we just wanted to give you a brief introduction of who we are and why we're here, but now we want to know a little bit more about you. So we're only going to launch a total of 3 polls today. And the first poll that I want to ask everyone is, what kinds of options trading are you doing right now? And if you're not trading options, for example, you can answer options me no likey, one of Kurt's little poll answers there. If you're just getting started and you're not actually trading options, you can put that. Are you trading covered calls or the parity trade in a sense, naked puts? Are you looking mainly to trade long calls and long puts, speculating on market adjustments, market movements? Are you doing spread trades and combinations, the vertical spreads, for example, bear call credits, bull put credits, iron condors perhaps? Even the diagonals would fall into the combinations there. Or are you doing naked calls, selling call options with no protections in the form of another call or the stock itself? So we just want to get to know you, and this will actually help me when we get into the second part of our presentation when we discuss the trade comparisons as well. All right, well, we do have a large portion of our audience, it looks like, that's, I should say larger portion than I normally see, that are in that options me no likey category, which may be that you're not trading options right now, or, of course, you've got burned. Well, we've had the poll open for a minute, and well over 75% of our audience has voted, so I'm going to go ahead and close that poll, ladies and gentlemen. Let me share the results with you. 14% of those that answered say options me no likey, and that might be because, again, that you're not currently trading options right now. You're just seeing what's out there and what appeals to you with the different services and the different free webinars. But, of course, some of that 14% may actually be that you don't like options anymore, that you took a course and you got burned just as Kurt did, just as many investors have by following a strategy that didn't address the downside and it sounded really positive. So you might be in that category. And of course, the cure for that is education. And I think you're in the right place if that's the situation. If you don't like options right now, you've suffered some losses. You maybe even got wiped out by some positions because the downside wasn't addressed in the education that you took. I think you're in the right place. The winner today, 62%, is doing covered calls and naked puts. That's fantastic. That's kind of going to be one of our comparisons in the beginning. When we get to the comparisons, 57% are doing spread trades and combinations. 29% of our audience are doing long calls and puts. It's actually pretty low from what we normally see. But that's fantastic. We've got 5% doing naked calls. Well, you're a little bit more bold than I am, but that's okay. The reason why I say that is one thing I always like to mention when I talk about how I have my personal portfolio set up, as I did a few minutes ago. There are certain strategies I will not trade in my personal account, and those would be the iron butterflies, short straddles and short strangles, and naked calls, because they just don't match my risk-reward profile. So those of you trading naked calls, I hope you're doing really well, and I hope you have some good management techniques in there as well. Let me follow that up with one other poll, just to let me know, over the last 12 months, looking back over the last 12 months, are you happy with your trading results? And if you've done very well in the last 12 months, are you happy, but you could stand to be a little bit happier? Do you have mixed emotions? Like I explained with my covered call experience in the first 18 months, you've won some, but then you lost some. Maybe the losers were outpacing the winners. Are you just unhappy? Would you rather take a physical beating than keep seeing your money that you're investing in the market and your strategies just decline, decline, decline? Or are you ready to just throw in the towel? Okay, so just let me know how things went over the last 12 months. Okay. All right, we've had the poll open for about 45 seconds. I'm going to leave it open for another 15 seconds or so. Okay, oof. All right. Okay, let's leave that open for another 5 seconds or so. Again, we've got about 75% of our audience voting. I really appreciate that. We're going to just move on in just a second. We won't have another poll actually until the end of the presentation, okay? Excuse me, folks. Let's close that and I'll share the results. This is telling and unfortunate at the same time. No one said that they are extremely happy, that they've done extremely well over the last 12 months. We have 0%. Now, we do have 22% of our audience say that they're happier. Excuse me, they're happy. We could stand to be a little bit happier. That's good to see. This is usually what we see with this poll. It's unfortunate, but over the past 3 or 4 years that Kurt and I have been doing this, the answer to this poll usually comes out to the 20-80 split, and that's what we're seeing here today. 61% of you have mixed emotions. You've won some, but you've lost some, and maybe those losers have outpaced the gains, okay? 9% are unhappy with their trading results, and unfortunately 9% are ready to throw in the towel. Well, I think we're in the right place here. For those of you that are happy but could stand to be happier, well, we're going to show you some things today when we talk about the 3 core principles of radioactive trading, how that works with our techniques. But I think it's also going to help you because in my mind, as an options educator and an options trader the past 10 years, the 3 core principles that we apply to radioactive trading really apply to any trading technique. There are different caveats that, of course, can get you into trouble. 61% of you with the mixed emotions, absolutely. That's how I was when my first 3 or 4 years of trading, especially those first 18 months trading covered calls. I'd seen the possibility of returns. I'd experienced the possibilities of returns, but I was not getting ahead. And over the past 4 years, I've been very successful with the radioactive trading techniques and been happy with my trading results. And those of you that are unhappy, you'd rather take a physical beating, well, we're going to show you today these initial setups, of course, and the discussion of how we can enter in positions with limited risk. So even if we're wrong, we're not giving up much of our capital. We're not suffering catastrophic losses. And if we're right, well, maybe we are giving up a little bit on the upside, a small percentage on the upside because of the insurance policy, but we're still able to take advantage of 70 to maybe 75, 60% of the gain in the stock price as well. And those of you that say you're ready to throw in the towel, well, stay with me for the rest of the presentation, and hopefully I'll show you something that will make you consider staying in and trading the proper way, or trading a proper way with proper protection in place, guaranteed protection in place, rather. All right, so let's hide that and let's move on now. Let's see here. Okay, we're back to our slide presentations, and let's talk about the initial setup of the RPM before we jump right into those 3 core principles. RPM stands for Radioactive Profit Machine. This is Kurt's term for the initial setup and then the trades that are made after it. Many of you are familiar with the married put position, and many of you have read any free information at your broker, for example, or online, are familiar where a married put is buying stock and maybe buying a 1-month out-of-the-money put option. So today I may look at a stock trading at $35, and if I want to trade the stock but have some protection, I may buy the stock at $35 and let's say buy a July 30 strike put for 80 cents. Well, the problem with that is it still takes on too high of a percentage at risk. That $35 stock would need to drop 5 points in order for the insurance to kick in. Well, that's still above a 10% risk on the position. If I'm going to use insurance, I'm going to make sure that I'm keeping my costs down, but at the same time that I'm only risking single-digit percentage. Our setup, what we look to do is we're going to buy stock, and we're going to buy an in-the-money put that is at least 5 months out in time. All right? And the reason for this is going to take advantage of the 3 core principles. Now, common question that comes up here is that, well, if I'm buying stock and I'm buying an in-the-money put for protection, that means that I am bullish. And that is correct. We are looking for stocks that are bullish. However, there are ways to implement the radioactive trading techniques, the limited risk principles, and the 10 different income methods if you're bearish on the market or bearish on the stock as a whole. And we might talk about that a little bit later on in the presentation as well. A basic view of an RPM, and I looked at this morning, we're kind of around the same place. So some of you may say, why are you using a year-old presentation? Well, it's just we want to keep the numbers the same because of the comparisons that we're going to use later on. But actually, if we looked at this stock, PXP, today, the stock's trading right around 35.50, and if I went out to buy a January 2013 40 strike put, we'd have almost the same prices. Over the last year, PXP has moved up and moved down. It's fluctuated in price, but it's almost at the same price today. But let's just say, for example, it's June 20th, 2011, so just back about a year or so. At the time, we could buy shares of PXP, Plains Exploration, for $35.08. And at the same time, I'm going to buy a January 2012 40 strike put for $7.25. So we're going 6 months out, actually 7 months out. We're going to January 2012 from June 2011. The stock's at 35, and I'm buying a 40 strike put. So it's an in-the-money put that's several months out in time. Now, a lot of you will look at this and say, well, it's $42.33. You're not going to realize a dime unless the stock moves up to 42, 43. That's the same thing I said to Kurt 4 years ago. But we're going to dispel that myth in a minute when we look at the 3 core principles. Now, my guaranteed exit of $40. This put gives me the right to sell to close my shares of stock at $40 anytime between now and January expiration, even if the stock dropped to $1 per share. So the most we're risking on the position monetarily is $2.33, or $233 for 100 shares in one put, which comes out to 5.5% of our total investment. So this is the initial setup. When we open that married put position from the start, the radioactive profit machine, we're going several months out in time, at least 5 months out in time. I prefer to be around 7 or 8 months if possible. That's just a personal trade. We're going in the money, and we're really focusing on keeping this risk roughly between about 3.5% and 8.5%. Okay, so that's our initial setup. Now, why are we going in the money with this position instead of buying the out of the money? And why are we going several months out in time? That looks very expensive. Here's a breakdown of that position again on the PowerOptions Custom Spread tool. And quickly, I wanted to show you the profit and loss chart. So on June 20th, 2011, when we looked at this position and the profit and loss chart, the blue, let me get a better arrow here, folks. There we go. The blue hockey stick graph, this shows us our profit and loss chart at expiration. Meaning if I held the position all the way to January expiration and made no adjustments, yes, I would need the stock to be trading above that total price of $42.33 in order to realize a profit. But look here. This curved red line here is showing us the theoretical profit and loss if the stock was trading at these prices on October 27th, roughly the halfway point between June 20th and January 2012. And what we can see here is that even though we have $42.33 invested, with this curved red line in October, the break-even point is closer to only about maybe $38, maybe $37.50. We don't need the stock to be trading at $42.33. If it was, we'd probably have a profit of a couple $100, okay, at the halfway point. When you first open that married put position, let me go back 2 slides for us here, okay? Let me go back 2 slides. When I first opened this married put position, yes, I've put in the capital of $42.33. This 5.5% at risk is the worst case scenario, meaning if the stock, if I held the position all the way to expiration and the stock's trading below $40 per share, or $42.33, I'm sorry, below $40 per share, we would lose that 5.5%. Okay? The minute I open this position, I could turn around and liquidate it. I could sell the stock for, let's say, 35.07, and I could sell the put for maybe 7.20 or maybe 7.15. All I'm risking when I first open the position is the bid-ask spread between the bid-ask spread of the put option. So that first day when I open the position, I'm at break even. I'm not down $2.33 behind the 8-ball. All I'm losing when I first open that position is some commissions, maybe a little bit of the bid-ask spread. That's all we're risking. Okay. So this creates a low-risk position. It's an insured stock position. It's better than a stop loss because it's a guaranteed exit. I'm guaranteed. I purchased the right to sell to close my shares of stock at $40. So if the stock gaps down to $20 per share, if you had an 8% stop loss and you bought the stock at $35.08, you're not going to get filled at $33 or $32 for that 8% stop. The stock gap down to 20, the order is triggered, and you get out at $20 per share. I still have the advantage of choosing to sell to close my shares of stock at 40 and only risking 5.5%. It is still a bullish strategy because it results in a positive delta. I bought stock, I bought an in-the-money put this far out in time, so my stock will have a delta of 1. The put option will have a delta maybe between 0.55 and maybe 0.75, depending on which risk I wanted to take. And the setup takes advantage of the 3 core principles, the ATM bell curve, the red line, the radioactive decay line, or the time decay line, and especially FIST, forcing an ideal size trade. Okay, we have 2 components, of course. We're long stock and we're long an in-the-money, far out in time put based on the rules in the blueprint. Now, forcing an ideal size trade, one of the 3 core principles. By purchasing stock in the put option, we're forced not to overtrade or overinvest. Later on, we're going to get into comparison of setting up the RPM position we just saw versus setting up an out-of-the-money long call at the same time, or substituting an in-the-money long call for stock and buying the put position, and how that can lead to trouble with overtrading because you're not forcing yourself into an ideal size trade. The at-the-money bell curve, both the initial setup and the follow-up income methods allow us to manipulate time value in our favor. Those of you who are those of you who are covered calls traders, of course, and the spread traders, you know that the time value is the only true profit you make when you open a position. You're not making money on the intrinsic value per se. When you first open the position, your profit is maximized at the time value when you're selling options. And then, of course, the red line, many of you are familiar with this. Some of our spread traders may be doing weekly options. So when you're selling options, you want to be selling shorter term. But when we're buying options, we want to be buying farther out in time. Okay, and that's the proper use for using the time value to our advantage. Now, forcing an ideal size trade, many of you know that too large a risk is devastating. And the gentleman, W.E., that asked earlier, can we use this in the futures market, he's very aware of the risks involved in the futures and the leverage there. The lie of leverage and improper money management are what get investors into trouble all the time. Now, having the risk too small is a problem as well. I'm going to be upfront with you. If I set up a very put position that only had a 0.5 or a 1% gain, I do realize that my expectancy of profit is going to be too small. However, those of you that are selling premium, when we trade covered calls or when we do the spread trades, if we come across a position that looks too good to be true, we know that it is as well, and it's probably carrying too large of a risk. And keep in mind, if we look at our positions, if I came up to you and said, hey guys, I just had a great play, I made 100% on my last trade, your first question would be, oh great, what did you trade and how much money did you put in? If I just told you that I bought an out-of-the-money long call and paid 5 cents for it, and the stock moved up slightly, and I was able to get 10 cents when selling to close it, well, I made 100% on that trade. But if I only bought one contract, we're talking about $5 of profit. So if you wager too small an amount, or if you risk too little, 100% gain is not going to be too big of a deal. And also, we know very well that 100% gain is not a big deal if you had previously suffered a 40%, 50%, or 60% loss. If I just had a 50% loss on my first trade and then had a 100% gain on my second trade, we're right back to break even. So forcing an ideal size trade is very important. And let's talk about the 3 bears of trading in light of our married put position. Let's say we have a stock trading at $50 per share, and we're shopping for quality insurance on our position, what matches our risk profile, but still has a reasonable expectancy of profit. Well, if I buy the stock at 50 and I purchase an out-of-the-money 40 strike put about 10 points below the current stock price for $3, Well, I'd have $53 invested in the position, but if the stock collapses and drops to $10 per share or $5 per share, we're risking 24%, 24.5% of our invested capital. If I have a 25% loss on my position, I'm going to need a 33% gain on the next trade just to get back to break even. That's the slippery slope of the martingale, or what's called gambler's ruin. Now, if I look at the $50 stock and I buy a couple strikes in the money put, a $60 put, well, this might cost me $12.75. Now remember, $10 of this is intrinsic value, so our true risk is only $2.75. Yes, our cost is $62.75, but we're guaranteed an exit of $60. We're only risking $2.75, or about 4.4%. And as we saw before, I don't need the stock to be trading at $62.75 in the near term. If I held it all the way to expiration, let's say this put was 6 months out in time, I make no adjustments. Yes, I'm going to need the stock to be trading above $62.75 in order to make a profit. But in the first 30 days or so, I may only need to see a 2% or 3% gain in the underlying stock to realize a 1% or 2% return. Of course, if the stock moves up 8%, I could probably liquidate the entire RPM for about a 6% or 5%, maybe even a 7% gain, depending on how the put option is reacting. So the probability here on that first position is we might expect a 70 to 75% probability that stock would be trading above $40. Well, that's great, but it's still taking on too much risk. Here, if we have a bullish stock recently, we might be looking at a probability maybe around 35, 40, 50% or so, and that's great. Now, if we're really risk adverse, we could, of course, buy stock at 50, buy a deep in the money put. This is 50% in the money, the 75 put for $25.75. That's a lot of intrinsic value that we're paying for, but that's great because we're going to get most of it back. Right? We're $25 in the money. We have a put option at $25.75. We know our total cost is $75.75, guaranteed an exit of 75, so we're only risking 75 cents or less than 1%. But then the probability or the expectancy of profit, having the stock trading at that put strike price where it would be the logical time to apply an income method, or the best time I should say to apply an income method, is extremely low. So taking too little of a risk is going to lower your expectancy too much. Taking too high of a risk, well, we all know what happens with that when we suffer those 12, 15, 20, or 25% losses on a position, whether it be a covered call, a naked put, even if it's an unrealized gain. That's the position that stays in your account that you're stuck repairing for 6 to 7 to 8 months. What if we focus our attention on limiting our risks properly and still having a reasonable expectancy of profit? You know, we talked about if we have a 25% loss on the position, we're going to need a 33% gain to get back to break even. If you have a 50% loss in your position, you're going to need a 100% gain to get back to break even. I know this isn't the slide I'm showing, but if you have a 5% loss on your position, you don't need a 10% gain to get back to break even. Okay, you don't just divide by 10. If you have 50% loss, we need a 100% gain. But if I suffer a 5% loss on a position, I only need a 5.3%, 5.2% gain to get back to break even. What is more likely to have over a 20 or 30-day period, a 5.2% gain on your position after a 5% loss, or a 100% gain on your position after a 50% loss, or even a 33% gain on your position if you suffered a 25% loss? That's where our attention is focused. Now, this is a historical option chain. Around the same time we were looking at that PXP position, but this is actually for silver wheaten, and it's actually a year older. But just on May 21st, 2010, silver wheaten trading at around 1782. And what I want to show you here is just sort of the different ranges. Now here we see going out to December, 211 days out in time, about 7 months out in time from the time we looked at the trade. But the out-of-the-money puts, the December 15 and the December 16, these have low prices, $1.74 for the option ask, $2.18 for the option ask. But look at the risk. Okay, the stock would need to drop to 15 plus the payment I made. So we're looking at risks of 20%, 23%, 16%. This is not where we want to be. All right, the range out of the money, this is not where we want to be. We go too deep in the money, we just saw that. With stocks at 17, we go almost 100% in the money to the December 35 put. Well, great, that has a low risk of 1.2% and only 42 cents per share, or $42 per 100 shares, but it's so deep in the money that our expectancy of profit is going to be negligible. Okay, so where do we want to be? We want to kind of be in this range here. possibly even this range, but this is a little too much, and we'll talk about that in a minute. We want to be in this range of about the 5% to maybe even the 9% or less than 9% at risk. This is the area where we want to focus, where we want to focus our attention to our risk threshold, but without going too deep in the money. That's going to help us force that ideal size trade and also take advantage of the other income methods. So as you see, as we go deeper in the money, absolutely the risk is lower, but your expectancy of profit is too small. We go too far out of the money, well, that risk is just not what I want to take on my position. I want to focus on keeping it on the single-digit risks to force me into an ideal size trade. Our second principle, the at-the-money bell curve. Those of you who, the covered calls traders and our spreads traders, of course, even our long call buyers, you're familiar with this concept. The ATM bell curve helps us establish why, again, what we just saw, why aren't we buying puts that are out of the money? Why are we buying puts that are slightly in the money? Well, and also, the ATM bell curve principle is applied to the income methods after the fact to show how to make money after getting into the married put position. That's the standard for buying time cheaply but selling time value at a quality premium. These are dependent on understanding how, so the put that we select for that initial protection and the application of the 10 different income methods are kind of dependent on manipulating the time value. Now, let's just take a look here. This is what's known as the at-the-money bell curve, and this is for essentially a call series. Let's just assume a call chain, a 5-strike call chain. If we're looking at straight option premium, the highest option premiums themselves, the highest costs, are going to be here in the money zone. If we have our stock, let's say, again, trading at $50 per share, we know that the $30 call and the $25 call are going to have prices of around, let's say, $15, $25, $35, in that range. Let's just take the 30-strike call. It's going to be at least $20, but then maybe there's $1 worth of time premium. Okay? Whereas the 60-strike call here on the out-of-the-money range, let's say this is the $60 range for a call, well, the premium here might only be $1. Okay, well, let's keep it in 10 ranges. Let's say this is $40 here. Our stock's currently trading at $50. Well, the $40 call has to have at least $10 of intrinsic value, and maybe it's got about $1.50 worth of time premium, so we're looking at a cost of $11.50. But as far as the time value goes, the time value is cheap. It's only $1.50 of this $11.50 cost. Same on the upside. Our out-of-the-money 60-strike call, only priced at $1. All right, so it's a low time value, whereas our at-the-money 50-strike call, those of you trading covered calls, you might look at the at-the-money option. This at-the-money call might be trading at around $2.50 or at about $3, maybe around $2, but let's just call it $2.50. So as we go further and further out of the money, as we go to higher and higher strikes, the time value is going to decrease. And as we go deeper in the money, in this case in the calls, on a call chain, the time value is decreasing as well, but we are seeing an increase in intrinsic value. So when we're buying at the at-the-money bell curve, we want to buy out of the money or buy in the money to pay less time for our position. When we're buying, the time value is working against us, so we don't want to buy at the money. Of course, reverse is true. When we're selling, we want to be selling at the money to get the highest time value premium, the true profit. If you're selling any option, whether you're doing naked puts, whether you're doing covered calls, even spread trade positions, you get that best premium here right at the money sell zone. Now, real quick, and I know we're spending some time on this, but we want to make sure that we cover everything. This is kind of counterintuitive for those of you that are spread traders. Let's think of a bear call credit spread in this case. Let's keep our stock at 50 and assume this is a call chain. Well, to maximize the profits when I'm selling premium, I want to be selling at the money. But bear call credit spread traders, even bull put credit spread traders, know that if I'm trading a bear call spread, I'm selling up in this range. I may be, or actually probably up here, I'm selling a 60-strike call with a low time value, maybe buying a 65 because I want that higher probability of the stock staying below my short call strike price and expiring worthless. And the bull put credit spread, of course, or a bull call debit spread trader might be in this range here, where maybe we sell, let's say, a 42.5 or a 40 put and buy a 37.5 or a 35 put for the higher probability. But that's counterintuitive, isn't it? We want that higher probability of success in those spreads, but we're not taking advantage of the at-the-money sell zone. And covered call investors who sell at-the-money calls, they're getting the highest time premium, but they're only in that 50% probability. But we just wanted to exemplify that some of these other strategies that we're trading kind of go opposite of these three core principles which really apply to any strategy. When doing the spread trades, we have to go out of the money to get that higher probability, but we're not taking advantage of where the true premium really is. And that's okay. I wouldn't advise anyone to be selling out of at the money spread trade positions, but that's why the strategy as a whole sometimes has its flaws. From March 14th, 2011, Apple at $354. Oh, that would have been a nice trade, right? But in this case, let's just take a look at the chain from March 14th. We're looking at the April options for 2011 on 4/16. And here's just standard chain. Here's the stock at 353.56. Let's just call it 354. So the 355 call has a price of bid price of 10.90, an ask of 11.05. Well, the bid time value is at 10.90 or 3.1%. And of course, the put option here, we have a time value of about 10.61 or 3% as well. As we go deeper in the money with the call options, we notice this time value is decreasing, down to 2%, down to 1%. On the opposite side, as we go further down in strikes, okay, this time we're going further out of the money with the put, we see the same decrease. We're going down to 2%, down to 1%. On the other side of the bell curve, well, now as we go higher strike prices, which is out of the money for the calls, again, we drop down the time value, 2%, 1%, less than 1%. And as we go deeper in the money with the put options, yes, we have higher prices. So instead of, we're at $17.40 now, total cost $20.60 as we go deeper in the money, but that's mostly intrinsic. The time value is decreasing. So again, when we want to buy in the money range or the out of the money range, and when we sell, we want to sell at the money or close to it to take advantage of the at the money bell curve. Selling option premium to maximize the time value. Some of our income methods, some of those 10 different adjustments discussed in the blueprint will actually take care of both. Okay, they'll take advantage of buying out of the money options to limit the cost of time value and selling at the same time at the money options. Now our third principle is the time decay line. The time decay curve for an option, assuming implied volatility price of the stock stays the same, is similar to the radioactive decay of an element. This is where Kurt came up with the term radioactive trading, because that's what we're attempting to manipulate, as well as the at-the-money bell curve, and making sure that our risks are limited. The initial decay is slow when you first open an option, but it gets exponentially faster as you approach expiration. Remember, the only guarantee in options trading is as an option approaches expiration, the time value will go to zero. That's essentially the only guarantee in options trading. Now, the radioactive decay line sets the standard not only for buying time cheaply, just as the at-the-money bell curve, but it also sets the standard for giving ourselves time for the stock to move in our desired direction. Let's say that, again, we were looking at a stock that was trading maybe at $50 per share, and we're looking at a 50-strike call that's 120 days out in time. All right, so here's, let's just call this 120 as well. When I first open that call, if I buy that call, well, I'm expecting that I'm not going to see a lot of rapid decay in the first 30 to 60, even the 90 days. So from 120 down to 30 days, we're going to have a very gradual loss in our time value. But as we hit those last 30 days, last 30 to 45 days, we're going to see a much more rapid decay. Excuse me, folks. Now, this does assume, again, that implied volatility and other factors in the market stay the same. But we know that's not the case. But when we apply this to the general terms of the market, when we're buying, we want to be out here. I don't want to lose time decay. Time decay is my enemy when I'm buying a call for speculation, buying a strangle, for example, or even buying insurance. Time is going to work against me. So I want to buy out in time when the time decay is much slower. I don't want to see the time fall rapidly against me when I first open a position. When I first buy an option. I don't want to buy a 30-day out option. I want to buy 120, 130. Really, as I mentioned earlier, we want to go 6 months, maybe 180 to 200 days out in time on our position to have a slow decay up front, give us time to manipulate that time value in our favor. But of course, when we're selling premium, we want to be selling with the shorter term, 30 days, 45 days out in time, to have that decay work in our favor. Now, as investors, we know that the stock and the volatility never stay the same. However, we still want to put those principles at work for us. Okay? We don't know the future, but we can manipulate the time value in our favor. All right? And also, we also know that the option, that 6 months out in time is never going to be 6 times the cost of the near-term option. It's just like buying insurance for your car, for example. If you pay month by month by month, you might be paying $100 per month for your car insurance, which would equate to $1,200 per year. Now, if you tell your insurance company that you want to pay 6 months, you want to pay bi-yearly, so every 6 months you're going to pay, they're going to give you a little discount. They might only charge you $550 every 6 months, which works out to be $1,100 total. So you get $100 savings. And if you tell them that you want to pay it up front, they might even give you a bigger break and say, all right, well, if you're going to pay 1 year at a time, and every December 30th you're going to pay your yearly insurance, well, we'll give you a discounted break and you only pay $1,000. Options are the same way. If I buy the option that's 6 months out in time, I'm not paying 6 times the cost of the near-term option, so my cost per day is lower when I buy further out in time. And that also affects the selling. We get a higher annualized return when we sell premium month by month by month, but we get a lower cost per day when we buy further out in time. So those are just the brief summary of the 3 core principles of radioactive trading. Forcing an ideal size trade. We talked about the 3 bears there. There is such a thing as taking on too little risk, and there's definitely such a thing as taking on too high of a risk. The ATM bell curve, this not only helps us establish why we want to buy the put option in the money as opposed to out of the money or at the money, but we're also going to take advantage of that ATM bell curve when we apply the 10 different income methods onto that married put position. And then, of course, the radioactive decay line as well, which guides us towards why we're buying the put far out in time instead of buying a close in put. And when we use the income methods, why most of the income methods that we use we're doing with premium generation that are 30 to 45 days out in time, less than 60 days out in time. Okay? Now, if you have any questions just about the 3 core principles, go ahead and send them in. It is about 12:40, so we're going to just do, we're going to jump into that initial setup and the 10 income methods and the trade comparisons. But if you have any questions about those 3 core principles, go ahead and send them in, and I'll address those as we move forward. Okay? So follow up to initial position. We saw the married put, the PXP position that was risking 5.5%, buying stock potentially at 35.08, buying the 40 put for about 7.25, had that total investment of 42.33, guaranteed exit of $40, so we're only risking that 5.5%. Now, is that it? Am I just going to hold the position and hope that the stock's trading above $42.33, my cost basis, in the next 7 to 8 months? No. Blueprint teaches you 10 different income methods that you can use. If the stock moves up, there are income methods you can use if the stock stagnates, let's say in the first 20 or 25 days after you've opened the position, and there are adjustments you can use if the stock moves down in price after you first open. If you found out that you were wrong when you first opened the position, there are income methods that you can use as well. The blueprint teaches the SIGA model for each income method. This stands for the conditions, what has currently happened, your expectations. Well, now that I open the position in the first 20 days, the stock has moved or hasn't moved, what are my expectations going forward? And what are my goals for the positions? Each income method has a SIGA model, a decision-making matrix, to decide which one best suits your goals and your expectations. And again, this allows us to bulletproof the position and earn extra profits. Now, remember a little while ago we talked about the 2 components of our initial RPM setup. We're buying stock and we're buying a put option to guarantee an exit price, force an ideal size trade, taking advantage of the at-the-money bell curve, and of course the radioactive decay line. But a lot of investors, and maybe I'm sorry, I'm looking at the wrong number. I apologize. 62% of you said you trade covered calls and naked puts. You're probably familiar with this, as are the spread traders. Many investors will try to enter stock ownership or to enter stock by using a naked put. We're going to sell an at or slightly out of the money put option, generate a premium. Now, our obligation is we may be forced to buy shares of stock at that strike price. Okay, well, so I get stock at a lower price. Let's say the stock's trading at $43, $42. In this case, let's just take the PXP example. The stock's trading at 35 or so. I may sell the 32.5 or the 35 put, generate a $1 premium. Well, if the stock's trading below 35, my obligation is I may be obligated to buy shares of stock at 35. But that's okay because my cost basis is really $34 per share. And by itself, it is a parity trade to the covered call, and we try to get shares of stock at a discount. Oh, question. Phil, I'm sorry, Phil, you got to stay with me here. Phil said, why not use options as opposed to buying stock? Well, that's going to come in the second and third comparison. This is our first comparison using naked puts to enter the position, why I don't recommend that instead of opening the RPM. Second position will be, the second comparison will be substituting the stock and the put with an in-the-money buying an in-the-money long call and buying the put option. And the third comparison will be buying the out-of-the-money put. And I'm going to show you my thoughts into why I don't recommend doing this and why I tell my clients at PowerOptions, my customers, that this is a better way to set up the position. But I'll be with you in just a minute, Phil. Those will be our second and third comparisons for the afternoon. Okay. Well, let's get the numbers right. Let's go back to June 20th, 2011. Oh, don't be sorry, Phil. It's okay. I just don't want to get ahead of myself, and I want to make sure that we cover the bases. So no need to apologize, Phil. We're just going to get there in just a minute, and I wanted to make sure you realized what's coming up in just a moment. So 6/20/2011, remember we had PXP, Plains Exploration at 35.08. At that time, remember taking advantage of the at-the-money bell curve and our time frame, we're going to look to sell a July 35 put. So I'm selling now. I want to sell at the money, and I want to sell 30 days to have that time value work against me. Again, those three core principles, they're not just the three core principles for radioactive trading. They really apply to any strategy. And if you're not using those three core principles to the strategy you're using now, you might want to start addressing it. You might definitely want to take a deeper look at radioactive trading. So we could sell a 35 put at $1.24. Max profit of 3.7%. Okay, and if we sold one put option, we may be obligated to buy shares of stock at 35. So if it's a cash secured put, I'm going to have $3,500 on hold in my account. If the stock drops to zero, I keep that $1.24, but I lose the 35. So our maximum risk is a $3,376 for one contract. Those of you who are familiar with the covered call profit and loss chart and the naked put profit and loss chart, this goes opposite of that axiom we want to focus on. In this position here, we're cutting our winners short, and we're allowing our losers to run. This is not where we want to be, right? We want to be in that other position where we're allowing our winners to run, but we're cutting our losers short. And as Phil mentioned, you can do that with just buying options, and we'll look at that comparison too. So what if we combine these two? Now, we were looking at a stock position that we're bullish on. We added a put option radioactively because we want to keep our risks to 5.5%. But what happens if I want to try to get into this stock position at a lower price and still have my protection in place? What if I added that same long put that we were contemplating with the RPM setup for PXP against this short put position? Well, now we're going to sell a put, that July 35 put, which obligates us to buy shares of stock at 35 for $1.24. At the same time, I'm going to buy that January 2012 40 put for $7.25, just as we did with the RPM setup. So now my total net debit, my total risk on the position is $6.01. And we could potentially buy stock at $33.76. If the stock's trading, let's say, at $34.90 at July expiration, we'd buy shares of stock at 35, but we kept that $1.24. So now our entry point for the stock's at $33.76, not the $35.08 we would have paid with opening the married put position. What does this do to our position? Take a look here. Well, we do have a calculated return on the position. Remember, the married put return didn't show. It showed up as infinite because we haven't capped the upside. So with this sort of calendar put setup, selling the short put, the near-term put, 35, and buying it deeper in the money, far out in time put, is diagonal calendar spread. We have a max risk of 601, or 100%, and a max profit of $92, which is 15.3% of our investment. Well, that looks pretty good for almost a 30-day trade, June 20th to July expiration, which is around the 20th. The risk, though, is a little bit, about close to 2.5, 3 times. And look at where the risk is. Okay? What did I do? I was looking for a stock that I felt was going to move up in price. When I open an RPM, I'm looking for a position that I feel is going to move up 5 to 8% or has the potential to move up 5 to 8% in the next 30 days. By trying to use leverage, by trying to enter this married put position at a discount, by selling the put and then buying that same put I was considering for the stock, I've actually reversed my thought process now. I'm bullish on the stock, but my risk is all to the upside. If the stock gaps up in price, I don't make any more on this short put position. The most I can make on that short put is the $1.24 we collected. And as the stock moves up, our long put is now declining. We don't have that positive delta in our favor anymore that we had when we opened the married put to begin with. And so our problem here now is that we have a very short window of profit for the next 30 days. And if the stock jumps up in price, we have a gapped up to, let's say, $40, $41 per share, $42 per share crossing in earnings, we've put our risk on the upside in the general direction we thought the stock was going to go. We are reversing. We're putting ourselves in a position that's opposite of our initial sentiment just to try to use leverage and to get in at a better price. The reason why I bring this up and these other comparisons we're using is it's not just me having done this for the past 3 or 4 years or so, and during these webinars having the questions posed to me, and you're all asking the right questions. Phil, you asked the exact right question. Why wouldn't I use options, buying options instead of you buying the stock? Why wouldn't I try to use a spread position to enter the stock to begin with to get in a lower cost basis? And it's because we alter the dynamic of the trade. But I put this presentation together, not because of the questions that everyone's asking, and they're the correct questions. It's because these are the same questions I asked when I first started learning about Kurt's techniques 4 years ago. I've been trading options for 6 years. I've been teaching options. I've been talking to 15 to 20 customers per day via phone or email for those 6 years prior to I found and came across the radioactive trading techniques, and Kurt traded them to me. So when I first saw them, I said, oh, I see what Kurt's doing, but I can get in at a better price if I open this as a calendar put spread. Well, 9 times out of 10, actually I only opened 4 positions this way, but 3 out of 4 times what happened was that the stock moved up as I expected, and now I'm scrambling to buy to close this short put. Right? Once the stock starts to move up, once the stock goes up higher than $1.24, that premium I collected, I'm rushing to buy to close this short put and buy the stock because it keeps going further and further. All I'm doing is losing on the put and not gaining anything else as a positive delta. Yes, if the stock gaps down, or if the stock moves down slightly and stays within this $33, $34 range, we're forced to buy stock at $35, but that puts our cost basis lower than if I open the RPM to begin with. Well, that's a great place to be in. But of course, if the stock gaps down here, that price, remember, we're risking a fair amount of position. We're going to be forced to buy shares of stock at 35 or forced to buy to close that short put. Probably would have been better off just opening the RPM to begin with. So I just reviewed this. I could have fast-forwarded to, but I like showing it on the chart. We don't need to review this because we just talked about it. We're trying to time our trade, aren't we? One of the caveats, one of the quick sayings Kurt uses, don't time your trades, trade time. Using the ATM bell curve, manipulating the time value. When I try to enter an RPM by using that calendar put spread, what am I saying? I'm saying in the first 30 days, I want the stock to be trading just around $35 per share in that tight window, and then in the next 60 to 90 days after that first 30 days, I expect the stock to go up to $40, $42, $43 per share. That is tough to do, and if you can do that on a consistent basis, you're a better trader than I am, and you might be able to get away with that. But I was not able to do that when I first started trading radioactively, and I tried. If the stock goes up as we expect, we were looking for a bullish stock to begin with. We're going to suffer large losses. And as the stock moves up quickly, if the stock moves up quickly, we may have to scramble to buy the stock. Now let's just look at a brief other comparison side by side. The RPM, the max risk was $2.33, or 5.5% of our investment. The calendar put, remember, was a risk of that total debit of 601, and that's 100% of what we invested in the position. Now let's say I had initially $7,000 to open a new trade on June 20th, 2011. Well, with buying the stock and buying the put, I'm sorry, let's call it 8,500. Sorry, 8,500. Well, with the RPM, that dictates that I could buy 200 shares and 2 put contracts, right? So my cost basis, remember, was about $42.33. So if we did 200 shares and 2 puts, we'd be at a cost basis of $84.66. Okay, but that's still only 5.5%. The risk with doing this is if you, on the other side, were trading with $8,500, your total debit to buy 1 put and sell 1 put is 601. You may say to yourself, oh, I can trade 10 contracts. Ooh, that's not a good idea. Yes, you absolutely could. Buying 10 contracts of the long put and selling 10 contracts of the short put, well, that would put your risk at $6,010. That's a lot of money. That's a lot of risk to take in one position, okay? So I'm forced into an ideal size trade. I don't have the risk of overtrading. The RPM has the unlimited upside. When we first open it, we've got that positive delta. We've got that unlimited upside. The calendar put has a capped gain, and the risk is to the upside. Okay, so this is not a good approach. Now, if you have any questions about what we just reviewed about using the calendar put to enter the RPM, send them in now. Because we're running a little short on time, I'm just going to jump into the very next one. But if you do send in a question, we'll go back and take a look at it, no problem. We may go 10 or 15 minutes over today. I just want to brace you for that. I want to cover everything, and I want to leave time for your questions. Just to let you know, we may go 10 or 15 minutes over since we're already about 12:50, 12:55. Very quickly, once again, let's review that married put we were looking at on June 20th on PXP, stock at 35.08, January 40 put for $7.25, This puts our total invested amount at $42.33. We're guaranteed the exit of 40, so our total at risk is $233 or 5.5%. Now, second comparison, a second situation that comes up, why buy the stock? Why not maximize my capital and substitute buying the stock with buying an in-the-money call? So we'll use leverage to mimic stock ownership with a long call. Now, to mimic stock ownership, we want to buy an in-the-money call. Commonly what investors try to do is buy an in-the-money call with a high delta, a delta close to 1 if possible. My experience is if you're looking for a delta of close to 1 on a long option, a long call, excuse me, to mimic stock ownership, you've probably got 0 open interest and 0 option volume. So getting filled at the price that's shown might be rather difficult for you. Okay, but it's a lower cost. Naturally, the call is going to move up as the stock moves up. So can I substitute a long call for the stock and do better than the RPM? My experience is no, and let me explain why. If I buy an in-the-money long call and an in-the-money long put, this creates what's called an in-the-money long strangle. And as common long strangle is buying an out-of-the-money call, excuse me, and an out-of-the-money put. But when we change it, when we substitute the RPM, the in-the-money long call for the stock and the RPM, we're creating an in-the-money long strangle. Now, it does give us infinite profit on the upside and on the downside, and the only risk we have in that position is the time value for both options. Okay, so let's take a look here at our comparison. Now, again, 6/20/2011. We know PXP is at 35.08. Let's take a look at that. Buying that January 2012 40 put at 725. All right, so that was 14% in the money, 5.5% of time value. That's the true risk we had in the married put. We've got a delta of about minus 0.64. So as the stock moves up 1 point, we might lose about 64 cents on the put option, for example. Okay, and then at the same time, instead of buying the stock, what if we just went slightly in the money? What if we just keep it equidistant from the stock price? We buy January 2012. Okay, we're going to buy far out in time again. 30 call at 735. It's a little bit more premium than the 40 strike put there. Well, this is 14.5% in the money, 5.8% of time value, and the delta is at 0.77. Of course, we could go deeper in the money, but let's just take a look at this example. Buy one put for 725, buy that call for 735. Our total investment is 1460. Now the maximum risk is 460 or 31.5%. Because it's an in-the-money strangle, if the stock stayed at 35, your 40 put would have $5 of intrinsic value, your 30 call would have $5 intrinsic value. So you're not risking the full 1460. You're just risking the time value factor, that $4.60. But this is a 31.5% risk of that $14.60 investment. Okay, so let's just take a look at that using the Power Options tools again. Here's just the general breakdown, and here's our profit and loss chart. Now, what are one of the advantages of using the in-the-money long strangle as opposed to the married put position? Well, if there's an extreme gap down or an extreme gap up, we still have unlimited upside profit potential, and hey, we could see some gain down here. We remember we saw the married put. I'll just try to draw it real quick, but married put, we had our standard hockey stick graph that if the stock was trading below $40, we had that loss of 5.5%. But actually that was here. The maximum risk on the married put would have just been there. Okay? So in this case, if the stock drops, if it gaps down in price, well, hey, we might realize a profit. We did look for a bullish stock. We're not expecting that to happen. And of course it can happen. We could have a 35% decline on the stock and you'd realize some profit down here on the downside. And that's one of the advantages. But let's talk about the disadvantages. Well, naturally, now we have an increase in maximum risk due to buying into 2 time values. Remember, the monetary risk of my married put position, if I did 100 shares in one put, was $2.33 or $233. We were just looking at a maximum risk there of $460 for the in-the-money long strangle. So it's twice the monetary risk. And it says, oh, you want to use leverage to maximize capital. Not if I'm doubling my risk. That's not where I want to be. Now, it's doubling the risk monetarily, but percentage-wise, it's exponential. I use leverage to get in at 1460, but I could lose 460 of that. That's a 31% loss in the position. As we talked earlier, we know if we have a 33% loss, we're going to need a 50% gain to get back to break even on the next position. You start off the position delta opposed, not delta neutral. I don't like to say this position is delta neutral. It is delta opposed. As the stock moves up 1 point, when we looked at that, we would have a loss of 64 cents on the put option and a gain of about 70 cents on the call option. All right, so as that first point, that first point moving upwards, that's just, it's not a good place to be. And in the second place, if the stock moves down in price, well, we gain 65 cents on the put, but we lose 70 cents on the call. We're not getting anywhere. Lower capital is used, but but that means you still have the risk of overtrading. And I have two articles on this, by the way. There's two white papers we've done comparing an in-the-money long strangle to the married put position. And what we've seen in a regular market, when the stock moves up maybe 5, maybe 6% in the first 30 days, the RPM, the married put position, will have a gain of 3.5%, and the in-the-money long strangle is still losing. So in normal market conditions, if you're not trading a stock that has wild swings, in normal market conditions, the RPM will outperform that in-the-money long strangle. And even if the stock falls in price, if the stock fell 5 or 6% in the first 30 days, I'm not going to realize that 6% loss, that 5.5% loss we saw in PXP, that married put setup. My loss is only going to be 2% or so. But the monetary loss and the percentage loss on the in-the-money long strangle is going to be much higher. Real quick, Doug says, why buy put when buying call? Long call has limited risk and same P&L as a married put. Doug, that's our third comparison that we're going to get to in a minute. And there's ways to do that wrong, but there's ways to do that right, but most investors do that wrong. But our third comparison is the married put against the out-of-the-money long call. So just bear with me 1 second. We'll get to that in a moment. All right, my summary, my thoughts on the RPM versus the in-the-money long strangle. Well, we saw we had double the monetary risk. On the same day, we could open the RPM for a monetary risk of only 233. The in-the-money long strangle was 460, 31.5% of the investment. I'm forced into an ideal size trade with the married put position, and I'm starting off with a positive delta. Again, the risk here, and remember the cost was $15 or so, $14.60 to get into the position. Again, I have $8,500 into my account to open the trade, to get in a new position. I can only do 200 shares of PXP and 2 put contracts. Still only risking 5.5%. With a cost basis of $14.60, you had the same $8,500, you run into the risk of over trading. You've got to be extremely disciplined. And you're starting off with a delta opposed position. In those first, 1 or 2 point movements upwards or downwards, you're fighting yourself for not gaining anything as well. And that's going to be an issue with these types of trades, okay? All right, so let's go on. Now, I want to mention this real quick. Here's what I'm going to say. I mentioned when I wrote those we have two white papers, I should say, on comparing the in-the-money long strangle to the married put, one comparing a position on IBM, one on Russell 2000 from customers who sent in questions. Why wouldn't I open this as an in-the-money long strangle on the Russell, it was the ETF, IWM, I believe. My apologies, wasn't the index. And so we did a couple comparisons on that. If you haven't already received them, I see a lot of familiar faces online. I know I've sent you some of these comparisons in the money long strangle. But if you haven't seen it yet, you would like to, just send me an email to support@radioactivetrading.com and just with the title ITM long strangle, for example. And I'll send you those two white papers there that we did the comparisons of the in the money long strangle versus the married put positions. Okay? All right. So let me just send that as a chat message real quick. Hold on 1 second, folks. There we go. Sorry, folks, just typing and you're making sure I got everything right. Okay, I'm going to send you all a chat message, so to receive the In the Money Long Strangle white papers, and I did misspell it anyway, send an email to support@radioactivetrading.com with ITM Long Strangle, or just Strangle in the title there, and I'll send you those two white papers. Okay. All right, let's get down to where, that was kind of what Phil was asking, I believe, earlier on. Now let's get down to, I'm sorry, was it Dennis that asked about that long call there? I'm sorry, was that Dennis? Doug, I'm sorry, Doug, it was Doug, my apologies. Okay, so Doug asked, let's talk about the big detraction, all right? That married put setup we saw, that married put position, hockey stick graph, limited risk, unlimited upside. Big detraction, hey, this is the same profit and loss. It's the same thing as buying an in-the-money call. It's a parity trade. Buying an out-of-the-money call is a parity trade, but it's better. How can something be the same but better? All right, let's go back to our RPM position. Buying the stock at 35.08, buying the January 2012 40 put for 725, total investment of 42.33, guaranteed $40 exit, 233 or 5.5% at risk. June 20th. 2011, PXP at 35.08. This was closing price, by the way. I could buy to open the January 40 call. That's a parity trade, right? Buying stock and buying a January 2012 40 put option, isn't that the same thing as buying the January 40 call? Well, here the January 40 call had an ask price of 230. The maximum profit is infinite, just like the married put position, and the maximum risk is $2.30. So we just proved Doug's point, didn't we? Buying the out-of-the-money call instead of putting up all that capital to buy the stock is actually better. In this case, we've got 3 cents better. Remember, our total risk was 233 on the married put position. Long call is only risking 230. This must be a superior trade. Well, not necessarily. Okay, and let's talk about it. Profit and loss of the married put position. We all saw this. There's our put strike at 40, break even at 42.33. I've got $4,233 invested for 100 shares. Next slide. Well, this is the long call. I didn't copy and paste it. This was actually the long call position. Bought a call at $40 for $2.30. That's my maximum risk here over on the right-hand side. I'm sorry, the left-hand side, folks. $230. Break even would be $42.30 if I held the position all the way to December expiration and made no adjustments. We need the stock to be trading at $42.30 to break even. Okay? This is what I feel is important. I can't argue that the married put and the long call have the same risk-reward profile. I can't argue that, and I wouldn't spend time doing it. It would be a waste of all our times because the argument wouldn't get anywhere. I can't argue that you're using less capital. You're absolutely right. You're using less capital, so this must be a superior trade. But let's talk about this. The problem comes with discipline. And I know you can say, oh, well, I'm a disciplined trader. I wouldn't overtrade. I get 10 to 15 phone calls a week of investors who overtraded and are stuck in a position because they used too much leverage. They didn't address risk first. Problem comes with the discipline. If you don't enforce proper money management and forcing an ideal size trade, you're going to get in trouble, and these are not the same trades at all. The long call risks 100% of the investment. Now you can argue, but Mike, the investment is only $230. That was better than the monetary risk of $233 you had with the married put. And I got to agree with you. But if I'm forced to only buy 200 shares and 2 puts, that's forcing me to an ideal size position of, let's say, a monetary risk of $4.66. Are you going to do the same thing? You're looking at a position that you feel is going to move up in price. You want to take advantage of it. You're sitting on $7,000 or $8,500 of investing capital. Are you going to buy 1 call? Are you going to buy 2 calls so you're only risking the $4.60 compared to the same monetary amount I'm risking, the $4.66? Let's be honest about the nature investor. Most likely you're not going to do that. Okay, let's take the extreme example first. Let's use these numbers here. Let's say I've got a $100,000 account and you do as well. And right now we've got $17,000 in free capital to invest in a new position. Well, I take my RPM. I've got the stock with a cost basis of $42.33. I'm guaranteed an exit of $40, so it's $2.33 monetary risk. I can only buy 400 shares of this position, right? $17,000 to invest. I could maximize, my maximum investment would be 400 shares. This means I'm invested into $16,932 into the stock plus put combination. But remember, I'm only risking $932. I'm guaranteed to get $16,000 back because we bought the 40 strike put. So 4 puts at 40 strike, that's $16,000 guaranteed exit. The most I can risk of my $100,000 account is $932. That's less than 1% of my total portfolio. So even if this whole position goes against me, PXP went bankrupt, I'm only risking 1% of my total portfolio in this married put position. Now on the other side, well, you've got a $100,000 account, $17,000 of free capital. Your cost per contract is less, right? $2.30, but that's 100%. You could buy 73 contracts, right? $17,000, $2.30. That would give you a cost of $16,790. Your total risk is $16,790 or 16.7%. Okay, so same accounts, same amount of capital invested. The risk is exponentially different. Okay, so I'm exaggerating a little bit, but I'm exaggerating to prove a valid point. Okay, I know Doug or anyone else using long calls would not buy 73 contracts. You would not take that full $17,000 and buy 17 the what was it, 43 calls? Sorry, folks, 73 contracts, that's right. 73 contracts of PXP positions with your $17,000. But we have to be honest about the nature of the investor, okay? If you are disciplined to only buy 4 contracts, remember I'm buying 400 shares, buying 4 puts, risking only $932, all right? So if you're disciplined to just go in and buy 4 contracts at $2.30, well, you've only got a risk of about $9 and what is that, $920. You've got a lower risk. What do you do with the rest of that $17,000? Are you going to leave it at hold in your account? Or are you going to go buy 5 calls of XYZ? Are you going to go buy 5 calls of ABC? Are you going to go buy 5 calls of 1, 2, 3? Okay? You're going to probably reinvest the rest of that $17,000 into different positions. Using leverage, you're going to be able to diversify into different positions, but if it's the wrong market, you're now risking more of that $17,000 you had on hold in your account. Okay? The true parity trade. I'm not going to argue that buying a long call isn't similar to buying the married put, but you cannot tell me that the long call by itself is a parity trade to the married put. It is not. And you can't tell me that the, I'm sorry, I'm not trying to be direct here, but you can't tell me that the long call is better than a married put position. You can't tell me it's the same but better, because that just doesn't mean any examples, okay? If I'm going to buy 400 shares of PXP at 35.08 and buy 4 of those 40 put options, well, my total cost invested would be $16,932. Now, I'm risking $932, which is 5.5% of my invested capital, but that's still less than 1% of that $100,000 portfolio. The true parity trade is if you buy 4 of those January calls at $2.30, the cost now would be $920. All right, so you're risking $920, less monetarily than the married put in this example, this real-world example back from June 20, 2011. And that represents less than 1% of your portfolio. If and only if you take that remaining $16,080 that you had from that $17,000 in free capital, if you take that remaining amount, leave it on hold in your account, and don't open any other trades, don't buy any other calls with that remaining $16,000 in capital, now we can look at each other and say we have a parity trade. If you use any of this, if you buy more than those 4 calls, if you use any more of that $16,080 to enter into different positions, whether they're covered calls, you're buying more long calls, we no longer have a parity trade. I'm still risking that small amount of 5.5%, guaranteed exit, only 1% of my portfolio, but the minute you start using more of this capital, then we are no longer at parity. Okay, so that's the trade-off. And this is why years and years, over the past, close to 10 years now, I see this happen too often. We've all thought in our minds, it's a sure thing, I'm going to buy 15 contracts of this position. And when it's not a sure thing, you get that loss. And so that's now the problem, okay? That's what you run into. Okay, sorry, I was just looking at the last 2 questions. Let me just go up here. So let me take a few questions here. Phil said, can't you use one of your 10 adjustments to make this or the last example of RadioActive? Phil, no, I'm sorry. This presentation, we are back to basics. We're not going to share an income method in today's presentation. Thursday's presentation, we're going to share a couple. This was just back to basics, taking one step beyond the sketch, sharing the 3 core principles and the trade comparisons. I'm not going to share an income method today. We're already at 1:15, so we're about 10 minutes over. So we're not going to get a chance, unfortunately, Phil, but we will share one on Thursday. And Paul says, now we have non-working capital with no potential. Okay, I agree. But that's the point. Okay, that is, I'm not saying that you want non-working capital in your portfolio, but what happens when you put too much of your capital into various positions? You're risking too much. This is where the stumbling block is, right? And Paul, you said, you just asked me, what about the, I don't have it in front of me, of course, but you asked me, well, if I do that, Paul, if we do this, we have non-working capital. But let me review something with you real quick, okay? Let me review what we did at the very beginning. What were your answers here? And you told me what you had been doing about buying long calls, or I want to use long calls instead of buying the stock and buying the put. I want to trade my spreads because I want more of my capital working for me. Well, Paul, with what you've been doing in the last 12 months, were you happy with your trading results? Did you answer mixed emotions? Did you answer unhappy? Or I doubt you answered that your results sucked, or at least I hope you didn't, but you might have answered that too. Okay? We had no one say yes in the last 12 months they've done what they expected, that they were very happy with their trading results. So I agree with you. That parity trade I just showed about buying the long call and leaving the capital to hold, now your capital's not working for you. But you know what? You're still only risking 1% of your portfolio in that position, and that's where we want to be. We have to force ourselves into an ideal size trade. In any strategy, you have to be aware of your risks. I can't tell you how many times I've talked to customers just after the last 3.5, 4 years who've said they look at a position and they say, okay, well, not even the married put, let's just take a standard collar, which has a similar risk-reward profile to a bull put credit spread or a bull call debit spread. And I'll be doing a presentation on how I use standard collar positions by buying stock, selling it at the money, 35 strike call, for example. Let me hide that real quick, sorry. Buying stock at 35, selling a 1 month out 35 call, and buying an out of the money 30 strike put. And I have $7,000 to invest, so I do 200 shares. A customer says, oh, well, you're doing the same thing as a bull put credit spread or a bull call debit spread. I think I'm just going to mimic the same profit and loss chart you're doing with that, but with my $7,000, I'm going to open up 10 contracts. I'm okay when the stock drops to $28 per share. I've only risked, 4.5%, 5% on my position, which represents probably only 1% of my portfolio. The minute you overtrade, and I see this day in and day out. And thank you, Lloyd. Thank you for your, that's a better phrasing. I should have said this because I've seen this time and time again. Lloyd summed it up very nicely for me. Yes, I don't have capital working for me, but hey, it's better to have non-working capital than to have no capital left at all. And that's what the radioactive trading technique solves. And Ken, you agree? Ken doesn't see what's wrong with a married put position that's heavily in the money. Well, if you go too deep, let me run an example. Okay, I'm going to show how not to do an income method for Phil very quickly. Yes, I'm 15 minutes over, but we're going to do something real quick here before I come back to this slideshow. Okay, so let's give 4 more minutes here. I'm going to navigate right over to PowerOptions. In a minute, I'm going to show you how you can get a 14-day free trial to PowerOptions. In fact, I'm going to send you that link right now. Let's see here. Okay, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. And as radioactive traders, we use this to identify our positions. Now, I'm going to go into the search by symbol here. We're not going to go into the main search. I'm going to go into the search by symbol, and I'm going to look at, we're going to take a look at PXP today, just as we did before. Remember we talked about PXP there, and the stock was at 35.08. We were going out to December, was it? I believe with our put option. Let's see, more results. Let's see if we have December available here. Don't have December's. Let's try, oh, sorry, wrong month. Let's try January. Oh, I did do the January. That's right. I'm sorry, folks. I should have gone to January right away. All right, so here's all results. These are the combinations. Every strike January put on our PXP position. Now, today, I'm sorry, folks. Let's get the price, shall we? $35.62. That's where it is today. Now, it hasn't been trading right at $35 for the past year, but it's kind of interesting. It's right around the same price. The stock has gone as high up as $44 per share, I believe, in the last year, and as low as $28 over that time frame. And yes, that 6/22/2011 was a married put I had on PXP that worked out very well for me. But today it's at $35.62. Let's take a look at that 40 put real quick. All right, that January 40 strike put priced at $7.50. Wow, it's pretty close to what we saw before. Total risk is $312, so a little bit higher than our 230 or 7.2%, 12% in the money. This range here, maybe going the 41 or the 42, might be more along my lines of the risk, 5.7%, 6.3%, going 17% in the money. Now, Malcolm asked, okay, I don't see the problem with going too deep in the money. Okay, let's go about... I'm going to go 50% in the money. Just as we saw before, remember earlier in the presentation we looked at silver wheaton. Our stock's at $35.62. Take a look at the January 55 put with a price of $20.10. Total invested is $55.72, but now we're only risking 72 cents or 1.3%. That's 54% in the money. Okay, well let's take a look at our profit and loss chart. Now I can't argue this point again. I can't argue your point that having this low risk is great. 1.3%. So happens that because of the way this is stretched, we're not seeing the rest of the profit and loss chart here. Right after 55, our break even would be 55.72. So right about here. So what we'd see here is this would continue to go up, and there's our infinite profit and loss to the upside. Now, we are taking advantage, of course, of the at-the-money bell curve and deep in the money. Income method number one that you learned from a sketch is common, selling a call against the married put. Let's create a collar. Okay? Problem is, you do have a very low risk here of $72. So let's look at a July call that's trading at around 80 cents, and let's see if we can get this position bulletproof from the start. You've got such a little risk, let's try to do that. All right. So I'm going to pull up the options here. I'm going to go to July 21. Oh, that's easy enough. I can go with a 38 call, 75 cents right there. The position's now bulletproof. So I'm going to buy stock. I'm going to buy the January 55 put option for 2010, and we're going to sell the July 38 call right now for about 75 cents, the natural bid price. That's going to bulletproof the position, isn't it? Well, you're going to bulletproof it to the downside, but you're going to destroy it on the upside, the direction you thought the stock was going to go to begin with. This is the problem, not just this itself. This is two different things I'm teaching here that we're showing. Buying the put too deep in the money gives you that lower risk, but you've lowered your expectancy of profit. Taking advantage of the at-the-money bell curve, the best time to look for one of our 10 income methods is when the stock is trading right at the put strike price. I don't want to go too deep in the money because I'm sitting on the position too long waiting for a logical time and a good time to make an adjustment. So if I go this deep in the money and I take this risk, a lot of the other frequently asked questions, why don't you sell a call right away? Why are you waiting for the stock to move up? Because you're going to go against yourself. Why did I open this position? I opened this position because I was looking for a stock that I felt was going to move up 5 to 8% the next 30 to 60 days, following the rules in the blueprint. Why would I want to sell a call and cap my gain right away just to limit the risk? Well, it's great that I have this limited risk. Where's my potential for profit? All right, jumping in too soon, buying that put too deep in the money, selling the call too soon at too little of a strike price before the stock has made a move will help you lower the risk up front, but what are you giving up? You're giving up the whole point of being in the trade to begin with. You're giving up that profit to begin with. Okay? So this is why the risk of going too deep in the money is that you're lowering your expectancy of profit, number one, to begin with. Number two is you try to force a manipulation because the stock hasn't moved. You try to generate premium to lower the risk too soon. You're killing your upside. Absolutely killing it. Okay? So that's 2 for 1 there. That's why we don't go too deep in the money and why we don't sell the call too soon. All right, let me get back to our slideshow. Again, we talked about just my review. You can disagree with me. Leave the conversation open. Send me an email to support@radioactivetrading.com with your thoughts. I do feel the RPM is superior to those 3 comparison trades, and I actually tried to trade them 4 years ago when I first started learning it. I'm not doing this because these are the questions that get asked during the webinar. I'm doing it because I see the questions asked in the webinar, and I went through the same process as an options trader. And I can tell you with my last 4 years of experience that this is the RPM itself has worked out for me better than when I tried to use that calendar put to enter the position, the in-the-money long strangle, or the in-the-money long call, because the minute you start, the out-of-the-money long call, ladies and gentlemen, my apologies, because the minute you start using that for leverage and then you start adding more money in, you get into that 1 month or 2 month down market, you see that your whole portfolio is down. You'd have been better off only risking 5 or 6% in that married put to begin with. But hey, I want to encourage to hear your thoughts and comments on the blog, on send me an email to support@RadioActive Trading. Okay, and let me ask this. What was I going to ask? I'm sorry, folks. Let me ask the. This is the one I want to ask. Let's just ask this one. In order to make a real, if you could go back in time, and you could change, you could open positions with only 6% at risk, or 1% of your portfolio from what you did over the last 12 months, would this make a real difference, or were you already managing your losses to less than 1%? Paul asks about how long do you wait to buy a call. Paul, I think you mean sell a call, but that's okay. That's what's discussed in the blueprint. It's not so much about waiting in a time frame. It's about having it match the SIGA model. There are things such as nested spread trades we can do, spread trades, vertical spread trades that don't add any risk, nested into the married put position, where you don't add to your risk, but you still have unlimited upside. Income method number 6, for example, is one of my favorites. I don't like income method number 5 as much as Kurt does, but I'm a fan of income method number 6. So the trick there, Paul, is that it might be a time frame. Okay, there's certain things that if the stock hasn't moved in the first 20 days, I might look at one of the neutral positions, one of the neutral income methods. If the stock moves up 5% or so, 5 to 8%, or is trading at my put strike price, that's when I might look to apply one of the bullish income methods, 1, 3, 4, 5, and 6. Stock stagnates, I'm going to consider 6, 7, or 8. If the stock's fallen in price after I first opened the position, I might consider 7. I'm sorry, yeah, I might consider 7. I might consider 8. More likely, though, I'm looking at 6, 9, or a combination of 9 and 1 and 6 and 1 if the stock drops 5 or 10% in the first 15 days or 20 days after I've opened the position. So that's what's the advantage of having those 10 different income methods, different quivers in your, different arrows in your quiver, lack of a better term, to use in different market conditions. Oh, hey, and how about, let me close this and share the results. This is kind of what I expected, but we just want to remind you, what would this do for you? Where do you want to be in the next 12 months? Okay? If this would have made a real dollar difference to you, if you limited your risk to 6% or less than 1% of your portfolio, where do you want to be 12 months from now? I mean, we looked at PXP trading at 620 2011, and we looked at today, it's almost trading at the same price, but it fluctuated in between there. But where do you want to be in June 20th, 2013 when I ask this question again? Okay, do you still want to be unhappy with your trading results? Do you want to be having mixed emotions with your trading results? Why are you having mixed emotions? Well, because those losers are outpacing your gains. Okay? All right. Let me hide that, folks. Let's get back. And let's talk about what to do now. Okay, what to do now. If you have yet to do so, go to RadioActiveTrading.com and click Get the Sketch. I know most of you already have done that because you were in the mailing list for the invitation for today's webinar, but if you haven't gotten the sketch yet, go to RadioActiveTrading.com and fill in your name and email, click Get the Sketch. And take advantage of the free resources. There's a tab on RadioActive Trading for free resources, the trade simulator tool, which we won't have time to go into. Go through the blog, read through some of those blog articles, the comparison of the long call versus the Mary put, Kurt's thoughts on that. Different income methods are discussed in the blog, and it's free. We have a listing of, we have other live upcoming webinars. We have archived webinars for you as well. And then, of course, that free trial to PowerOptions. And, of course, use your support for any questions you have later on. Send me an email to support@radioactivetrading.com. There's also a toll-free number that you can call. Of course, I won't be available for the next 20 or 30 minutes, so I do apologize for that, but I'm going to have to eat something. But give us a call during market hours at the toll-free number. So go to radioactivetrading.com, and again, if you haven't already, folks, put in your first name, last name, and email address, and just click Get the Sketch. Okay, that free white paper. This was a little bit beyond the white. This is supposed to be a step beyond the sketch there, and I think we've achieved that. But if you haven't done it, make sure you get this so you're on file there with the sketch document. Of course, you can check the blog. I mentioned those free resources there as well. This is where you can access the trade simulator tool. Kind of plug in your numbers of what you've been expecting to see in your trades with your risk level and what your profit goals you were looking for there here in the trade simulator tool, and see how that would work out, see how that simulation would work for 100 trades. And then, of course, the free resources here, the 14-day free trial that I sent you that you can sign up for to get comfortable with the tools and power options. Free webinars and podcasts. We have a variety of different webinars here. This presentation, of course, 3 core principles in trade comparison. I'm feeling good with this position, so I'm probably going to replace that webinar with the one from today, and that'll be in the archives later on this afternoon. So you want to get in there. You want to play around with it. Keep reading the other information. See if you have any other questions. And as soon as you do, use your support. Send me an email. Give me a call. Now, the only place to obtain the full techniques and the 10 different income methods is the blueprint. The blueprint itself is 250 pages of investing material that Kurt originally started with and Ernie has added to. When we first met Kurt, he only had 6 income methods. Myself, Ernie, in discussions with Kurt, we've expanded that to 10. Kurt's actually working on an 11th income method as well. You learn how to properly limit risk, and we talked about that today, the proper money management, in-depth detail of all 10 income methods. Kurt has 6 Mastery Series CDs. They're video CD presentations that go through the different income methods in the proper groups, profits with puts, the money nets, those 2 nested spread trades I talk about that we may take a look at on Thursday. But we're going to give you, if you purchase the blueprint, we're going to give you a free Foundations of Radioactive Trading CD. This goes more in-depth into what I presented today about those 3 core principles, the initial setup and the first income method number 1. And of course, the blueprint comes with a money-back guarantee. If you're not satisfied with a product in the first 30 days with the blueprint or the home study kit, you can send it back to us as well. All right, let me just navigate over to give you a little better idea here. I apologize of the, sorry folks, there we go. You go to radioactivetrading.com and you go into the products here. See, the blueprint is $339, and that comes also with $11 for shipping, so it's $350. But it comes with a money-back guarantee. And I think we've kind of shown and we've kind of related to you what is the importance of keeping your risks down to single-digit percentages. How much money have you lost over the last 12 months by not forcing an ideal size trade and proper position sizing? And where do you want to be next year? 12 months from now, where do you want to be when I ask you that question again? Okay. You can view the table of contents here right on the products page. You can even listen to the first chapter for free. So the bonuses that we have with the blueprint right now, if you purchase the blueprint, we're going to send you that free Fort CD, Foundations of RadioActive Trading, with your blueprint. Kurt has a document he wrote up called the Quick Action Guide to help you get started quickly. We're going to send that to you for free as well. You're going to get a free month, free 30-day trial of Power Options that you don't have to start right away. You can take your time and start that 30-day trial when you're ready. Kurt has a service called Fusion here on RadioActiveTrading.com where you can follow his trades, you can follow Ernie's trades. Kurt also has some timed lessons set up for you to help you absorb the radioactive trading material in the blueprint there. And as a bonus, if you purchase the blueprint, we're going to give you a coupon to get your first month of the Fusion service to follow those trades and go through those lessons for only $10 as well. And then, of course, we still have the money-back guarantee. Now, the home study kit also comes with the money-back guarantee. You also get those bonuses I just described if you pick up the home study kit. But what you get with the home study kit is you do get the blueprint, you get those bonuses, but then you get the 6 Mastery Series CDs as well. Now, the total cost for the home study kit is $5.99, but it's a 35% discount if you bought the blueprint and the CDs separately. So each CD covers one or two of the different income methods. For example, there's the Fort CD we talked about. Income Methods Beginnings, it's focused on income method number 1 and 2. Profits with Puts, detailed looking at income method number 3, and one of my favorites, income method number 4. The Money Net CD 5 and 6, those are the nested spread trades. Advanced Income Methods number 7 and 8, which are best used in the neutral market, and then number 9 as well, number 9 and combinations, 9 and 1, 9 and 6 if the stock moves against you. There's a great way to apply 3 and 1. 4 and 6 is one of my favorites to do if the stock does that. It does the right thing for me. So that's one of my favorites as well. Now, you can apply the radioactive trading techniques with just the blueprint. Okay, everything you need to trade it is in the blueprint itself. What the advantage here is of the radioactive home study kit is that if you learn a little bit better by watching these types of presentations, these video presentation webinars where you can see the slides, you can see the images in front of you, that's what helps you. Now, everything here, the discussion of 1 and 2, 3 and 4, 5 and 6, all what's contained in these Mastery Series CDs is also taught in the blueprint. There's a few different examples in the CDs, and in addition to that, there's just some more recent examples. But everything you need is in the blueprint, but if you learn a little bit better by watching a video presentation than the CDs, that's the way you want to go, the home study kit. And it is, you may say, oh, well, that's almost twice the cost. Yeah, but it's 35% off of what it will cost you if you picked up with the blueprint and then later came back to buy the CD. So if you're serious about it, I want you to consider that home study kit. But of course, everything you need to trade radioactively is available in the blueprint as well. And hey, don't feel obligated to buy right now. I'm not forcing you into a position where you want to buy right now, but take a look through the blog. Go through some of the other archive presentations. Use your support. Send me an email. Give me a call during market hours. There's contact links at the bottom of every page there. Down here at the bottom, you can see the toll-free number. Like I said, unfortunately, I'm not going to be available for the next 30 to 40 minutes, of course. But later on today, if you still have questions, you want some other comparisons, you want to discuss some things with me, give me a call at the toll-free number. Send me an email today. We'll set up a time to talk. Use that support and let me know. Also, of course, we have live webinars during the week. Remember, every Tuesday and Thursday at 12 noon. We have those webinars there. We'll have one Thursday at 12 noon as well. I want you encouraged to join me for that where we discuss some of those income methods. Again, send me an email with any of your questions. Give me a call during market hours. Ladies and gentlemen, thank you for joining me this afternoon. It's a great pleasure. I hope you all got some useful information. I'm sorry about going over time. I just wanted to make sure I handled those questions properly, showed a quick example about going too deep in the money with the Power Options tools and the risk of selling that call too soon. So I hope that was all useful. That was very useful to the rest of you. Hope you join us on Thursday. I'll also be hosting a Power Options presentation tomorrow at 12 noon, introducing the Power Options tools. So you may want to check us out for that as well. Have a great day. A happy trading week, ladies and gentlemen. We'll talk to you soon. Good night.